Big news for the markets. Rate cut expectations just surged after Friday's core PCE data hit. Here's what happened. The core PCE inflation rate for August came in at 2.7% year-over-year, perfectly matching forecasts. But what's really surprising is that despite this, the rate futures market now believes we could see even bigger cuts to interest rates soon. Why? There are two key reasons. First, housing. While housing only accounts for about 17% of the PCE data compared to 30% in CPI, the way housing is calculated is similar in both reports, and in August, the housing component grew 0.92% year-over-year, a slight uptick from July's 0.915%. So, based on this, next month's CPI might also see a small bump, but nothing major. Secondly, some of the bigger drivers in the PCE, like transportation services and other services, didn't move much or even declined slightly. Goods like non-durable goods continued their downtrend as well. So, while inflation is still sticking around, it's not dropping fast enough to trigger panic. The good news? This means we're likely to see a similar pattern in the next CPI data. Steady inflation without a big drop. Why does this matter? Markets don't want inflation to fall below 2% because that signals a sudden economic downturn. A healthy inflation rate is between 2% and 3%. After the PCE release, rate futures markets got even more bullish. They're now betting with a 52.2% chance of a 0.5 basis point rate cut in November, up from just 10.3% last month. And for December, there's nearly a 50% chance of a 0.25 basis point cut. If this happens, we'll see the dollar weaken, while gold and bonds rally. So, make sure you adjust your investment strategy accordingly.